I am about to show you 5 patterns that may quietly sabotage your long-term investment results, and you have probably done at least one of them this week without noticing. This video is not for people who are gambling. This is for you if you are generally sensible, you read, you think, you try to be rational, and yet when markets move sharply, you feel your body tighten and your mind starts searching for an exit. You may recognize yourself in this. You tell yourself you are a long-term person, but when prices drop you start checking more often. You feel a pull to do something. You start thinking about selling just to stop the discomfort. What makes panic selling so frustrating is that it often happens to intelligent people. It happens to people who know better. It happens to people who can explain what they should do and yet still feel pulled towards the opposite. That is not because you are weak. It is often because your brain is doing exactly what it evolved to do. There was a specific moment in 2020 during the early stages of the pandemic when markets were falling rapidly. Headlines were dramatic. Every day there were new predictions about economic collapse. I remember opening my investment at multiple times in one afternoon. I could feel a tightening in my chest. The drop felt personal, even though nothing in my long-term plan had changed. I remember thinking, I understand volatility in theory, but what if this time genuinely is different? That moment was important. Not because I sold, but because I realized how persuasive fear can feel when uncertainty is high. You may recognize this if you start bargaining with yourself. You may say you are only selling for now. You may say you will buy back later. You may tell yourself you are protecting what is left. You may even call it being responsible. Here is a simple framework that helps. Think of investing as flying through turbulence. Turbulence feels dangerous even when the plane is structurally fine. The feeling is real. The danger is often overstated. The goal is not to eliminate turbulence. The goal is to avoid grabbing the emergency exit mid-flight. Later, I will explain the most overlooked reason smart people panic sell, which often has less to do with the market and more to do with how you have structured your life. Let us start with the first pattern. The first pattern is checking too often. Checking too often means you monitor prices and news frequently enough that you begin to experience normal volatility as personal threat. For example, you open your investment app multiple times per day. For example, you keep financial news running in the background. For example, you follow commentators who speak confidently during uncertainty, which makes you feel that you are behind if you are not acting. Here is what this can cost you. It may amplify fear. It may increase impulsive decisions. It may lead you to sell at the worst possible moment simply to relieve discomfort. To protect yourself, you could take 5 steps. First, choose fixed review times, such as monthly or quarterly. Second, remove shortcuts to investment apps from your home screen so checking is not automatic. Third, reduce exposure to sensational financial content that is designed to trigger urgency. Fourth, write down what you are invested in and why, so you do not have to rediscover your logic during stress. Fifth, ask yourself whether checking is changing outcomes or simply changing emotions. Within days, you may notice reduced arousal. Within weeks, you may feel less reactive. Over months, consistency often becomes easier. The second pattern is investing money you might need soon. This pattern often creates panic because the risk becomes personal. For example, you invest money that is actually needed for upcoming bills, rent, school fees, or tax payments. For example, you invest your emergency reserve because returns feel more appealing than cash. For example, you rely on your portfolio as your psychological safety net rather than maintaining separate liquidity. Here is what this can cost you. It may create forced selling. It may create constant background anxiety. It may cause you to exit positions at the worst time, not because the investment was wrong, but because the timing of your needs was wrong. To protect yourself, you could take 5 steps. First, separate money into time horizons such as short-term, medium-term, and long-term. Second, keep short-term money in accessible, lower volatility places. Third, build an emergency buffer that is not exposed to market swings. Fourth, invest long-term money only when you can realistically leave it untouched. Fifth, review upcoming financial commitments so you know what liquidity you may need. Within a month or two, you may notice something subtle. The market can still move, but your reaction changes. If prices drop, you do not immediately feel threatened because you know your short-term needs are covered. You may still feel discomfort, but it does not escalate into urgency. The difference is not that volatility disappears. The difference is that your survival is no longer tied to your portfolio's daily movements. The third pattern is confusing "I feel unsafe" with "I am unsafe." This distinction is crucial. Behavioral economist Daniel Kahneman, who studied decision-making under uncertainty, showed that humans tend to feel losses more intensely than gains of the same size. This is often called loss aversion. A 10% drop can feel more painful than a 10% rise feels rewarding. When markets fall, your nervous system may interpret that drop as immediate danger, even if your long-term plan remains intact. For example, you may see red numbers and assume permanent loss, even though volatility is part of investing. For example, you may interpret a decline as proof you made a mistake when it may simply be normal fluctuation. For example, you may imagine worst-case outcomes vividly and then act as if they are certain. Here is what this can cost you. It may lead you to lock in losses. It may interrupt compounding. It may create the cycle of selling low and buying back higher. To protect yourself, you could take 5 steps. First, remind yourself that volatility is expected in most growth assets. Second, look at longer timeframes rather than daily charts. Third, use probability language such as "this could happen" rather than certainty language. Fourth, define in advance what would genuinely justify a change in strategy. Fifth, use a cooling-off rule such as waiting 48 hours before selling during stress. Within weeks, your decisions may feel less urgent. Over time, you may notice that discomfort does not automatically lead to action. The fourth pattern is not having a written plan. Without a plan, every market event forces you to improvise. For example, you invest because it seems sensible, but you have not defined your time horizon. For example, you do not know your risk tolerance until a drop happens. For example, you do not have rules for what to do during volatility, so you rely on mood and headlines. Here is what this can cost you. It may increase inconsistency. It may make your results depend on emotion. It may leave you vulnerable to persuasive narratives. To protect yourself, you could take 5 steps. First, write a simple investment policy in plain language. This does not need to be complicated. It could be 1 page. For example, you might write, "I invest monthly into diversified funds for long-term growth. I expect volatility. I will not make changes based on headlines alone." The point is not to sound clever. The point is that when markets move, you are not trying to remember your philosophy under stress. You are simply rereading what you already decided when you were calm. Second, define your time horizon for each allocation. What I mean by that is this: if you have money for retirement in 20 years, that horizon is very different from money you may need in 3 years for a house deposit. For example, long-term retirement funds might tolerate deeper swings. Medium-term goals may require more stability. When you label money by time, you reduce the temptation to treat everything as urgent. Third, specify what would justify selling based on fundamentals rather than fear. For example, you might decide you would sell if your personal goals change, if your risk capacity materially changes, or if the investment thesis is structurally broken. That is different from selling because the news cycle feels dramatic. Writing this down protects you from redefining reasonable in the middle of panic. Fourth, choose a risk level you can emotionally tolerate, not just one that looks optimal on paper. For example, if a 25% temporary drop would keep you awake at night, your allocation may be too aggressive for your temperament. It is better to hold a slightly more conservative allocation consistently than an aggressive one you abandon during stress. Fifth, automate contribution so you build steadily rather than episodically. For example, instead of investing only when you feel confident, you could set a fixed monthly contribution. This reduces the temptation to time the market based on mood. Over time, this kind of steady input often reduces the emotional intensity of individual market moves. Within a month, clarity often reduces anxiety because you are no longer improvising. Over several months, you may notice something important. You still feel market movements, but you do not feel compelled to act on every feeling. The difference is not that fear disappears. The difference is that structure absorbs it. Now we come to the most overlooked reason smart people panic sell. It is often not the market. It is life instability. When your life feels financially tight, markets feel more threatening because you have low margin. For example, if your fixed costs are high, a portfolio drop may feel like a real threat. For example, if you lack liquidity, volatility may feel dangerous because you cannot absorb shocks. For example, if you are overworked or exhausted, your emotional capacity to tolerate uncertainty is reduced, and selling feels like relief. Here is what this can cost you. It may turn your portfolio into a stress valve. It may cause you to sell for emotional relief rather than strategic reasons. It may keep you in short-term thinking despite long-term goals. To protect yourself, you could take 5 steps. First, reduce fixed cost pressure where possible to create breathing room. Second, build liquidity so surprises do not force investment decisions. Third, separate your identity from your portfolio performance. Fourth, regulate stress before making financial decisions. Fifth, design your investment approach around the version of you that exists during stress, not just during calm. Within weeks, you may feel less reactive because your environment is more stable. Over time, improved structure often improves outcomes. Let us recap clearly. Smart people panic sell when they check too often, when they invest money they may need soon, when they confuse feeling unsafe with being unsafe, when they lack a written plan, and when their life has low margin so volatility feels threatening. You are the sort of person who builds a system that protects you from your worst moments rather than expecting your emotions to behave perfectly. If this resonated, comment calm plan. It is a simple orientation. Subscribe if you want structured thinking about money and behavior in volatile times. In the next video, we can design a simple volatility protocol so you know exactly what to do when markets drop without having to think clearly while you are stressed. I will see you there.